All right, welcome to Talk Tickers. So AutoZone just dropped its Q4 earnings, and, well, on paper, it looked like a miss. But here's the weird part. The stock didn't really move. So what's going on? What did Wall Street see that the rest of us might have missed in those headline numbers? Let's dig in and figure this out. Okay, so here's the big number, the one that should have sent the stock tumbling. AutoZone's earnings per share, or EPS, came in almost $2 shy of what analysts were expecting. I mean, usually a miss like that is a straight-up recipe for disaster, a big sell-off. But crickets. The stock basically held its ground. So you gotta ask, right? What on earth did investors see that made this miss okay?
And this is where the plot really thickens. Yeah, the bottom line, that EPS number was a letdown. But look at the top line, the revenue. It was pretty much exactly what everyone expected, and even better, check out the same-store sales, up a really solid 4.5%. So, what does that tell us? It tells us people are still walking into AutoZone, they're still buying stuff. The problem wasn't a lack of customers. No, something else was putting the squeeze on their profits.
All right, let's peel back the layers on that profit miss. Because this is the key. It wasn't a sign that the business itself is in trouble. Not at all. The pressure on their margins really boiled down to two and only two specific culprits. One is a kind of quirky accounting rule, and the other was a deliberate choice they made.
So, the first thing we need to talk about is a bit of accounting jargon, but stick with me, it's important. It's called a LIFO charge. LIFO stands for last in, first out. And here's a simple way to think about it. With inflation, right? The last parts AutoZone bought for their shelves were the most expensive ones. LIFO accounting basically says, let's pretend you sold those newest, priciest parts first. The result? It makes your cost of goods sold look way higher, which, on paper, shrinks your profit.
And we're not talking about a small number here. This was a massive $80 million hit to their profit. In fact, the CFO even said on the call that if you strip out this one accounting charge, their earnings would have actually grown by nearly 9%. That's a huge difference. And get this, it's not going away. They're actually bracing for an even bigger charge next quarter, something like $120 million.
Okay, so that was piece number one. The second piece of the puzzle, higher operating costs. You'll see it called SG&A. That's just fancy talk for selling, general, and admin expenses. Now, normally when you see that number creeping up as a percent of sales, alarm bells start ringing. It can look like they're losing control of their spending. But that's not what happened here. This was totally intentional. It was a strategic move to pour more money back into the business to fuel growth.
So let's put it all together. The big takeaway here is that this earnings miss wasn't some flashing red light warning you that the business is failing. Not even close. It was purely the result of a non-cash accounting thing tied to inflation, and a very deliberate decision to invest in the future. I mean, that's a world away from a story about customers just not showing up anymore, right?
Okay, so if AutoZone is spending all this extra cash on purpose, you have to ask, where's it all going? Well, it's all part of a really clear, aggressive strategy to grab more market share. And on the earnings call, they laid out their game plan piece by piece.
And you can see the investment is absolutely paying off, especially in the one area they're targeting the most, their commercial business. This is what they call the do-it-for-me crowd, the professional mechanics and repair shops. Sales in that segment shot up by an incredible 12.5%. This right here is the growth engine that they are just pouring fuel on. And all that spending isn't just invisible stuff either. It's translating into a much bigger physical footprint. Get this. AutoZone opened 304 net new stores this past year. That is the fastest they've expanded since 1996. I mean, that's wild. And they're not slowing down. They're actually hitting the accelerator, aiming to open as many as 350 more next year. So if we zoom out for a second, management's playbook is crystal clear. Number one, win over the professional mechanics. Number two, open new stores, not just in the US, but internationally too. And number three, build out their network of hubs and mega hubs to get parts into people's hands faster than ever. And here's the kicker, they're managing to do all of this while still buying back their own stock and returning cash to shareholders. It's pretty ambitious. Which brings us to the next call, our take on the whole AutoZone picture. And really, what we're looking at here is a classic Wall Street paradox. On one hand, you've got these really obvious short-term pressures on profit. But on the other hand, you have this super compelling long-term growth plan that, well, it already seems to be working. So you can almost picture it like a tug-of-war for the stock price. In one corner, you've got the headwinds, and they are real. You've got those pesky LIFO charges that aren't going away.
the high SG&A spend for all this growth, and even some pressure from foreign exchange rates. But in the other corner, pulling just as hard, are the tailwinds, and man, are they powerful. They're crushing it with commercial clients, they're expanding their store footprint like crazy, and their core do-it-yourself customer is still holding strong. So the million-dollar question is, which side is going to win?
And you don't even have to take my word for it. The CFO, Jameer Jackson, basically laid it all out on the call. He said, we're investing heavily, creating a faster-growing business, and you can see the growth shoots in our current quarter's comp. I love that phrase, growth shoots. He's telling you point blank, yes, we're spending a lot, but look, you can already see the results in our sales numbers.
And it's for exactly that reason that we're giving AutoZone a market perform rating. We think the stock, right where it is today, is pricing in this exact tug-of-war pretty fairly. It's like the market is collectively saying, look, we get it. The profits are going to be under pressure for a bit, but we also see the growth story you're building, and we believe in it. So for right now, the price feels about right.
All right, last thing. Let's talk about how you could potentially turn this whole analysis into a trade idea. Now, big disclaimer here, as always. This is purely for educational purposes, a what-if scenario. This is not financial advice.
The idea we're looking at is something called a bull-put spread, and the logic flows directly from everything we've just talked about. So step one, you acknowledge that the upside for the stock might be limited in the short term because of those profit pressures. Step two, you believe that the long-term growth plan creates a really strong floor underneath the stock price, preventing it from falling too far. So if that's your view, that the stock is probably going to trade sideways or maybe drift a little higher, this strategy could make sense. In simple terms, it's about selling some options to collect a little bit of cash, betting that the stock will stay above a certain level. It's a way to potentially generate a return while you wait, and you know your maximum risk right from the start.
So we'll leave you with this one big question to chew on. With all this heavy investment hammering their short-term profits, is AutoZone actually building a wider, stronger competitive moat that's going to pay off for years to come? Or are they just digging themselves into a deeper hole for the next few quarters? That right there is the multi-billion-dollar question that investors are going to be wrestling with until the next earnings call.
This is not financial advice.